Thanks for coming in.
Hi, I'm Connor.
Connor, I know you. Thanks for coming in.
Pleasure, guys.
So y'all kind of jump right in, and I want Liv and I to kind of have a little bit of a discussion here and have that be the way and just kind of have a talk about it and present you with information and maybe have some questions. So let's see if I can get this right. Very simple. So you'll see the portfolio power. You will see non-QM, right? That's actually how it started, was non-QM loans, non-QM loans, non-QM loans. That just means not a qualified mortgage. So what is a qualified mortgage? A qualified mortgage was defined in the Dodd-Frank bill as being a loan that could be placed at one of these government agencies. That's it. That's all it is. If it does not meet these requirements, you get into a non-qualified mortgage, right? So where do these things come from? Private equity, hedge fund, investment, literally Goldman Sachs, TIA, CREF, the gigantic financial institutions, and it gets down to some real basic finance. They're chasing yield, right? They want a better return. They're not happy with these are very, I'll stop mucking up your screen too by touching it. These are very vanilla, simple, low risk loans. They don't pay the investor that much, right? Well, these do, right? These have a higher yield, right? They have a higher rate. So who's using it? We've now married these two together. Self-employment folks, investors, alternative buying, just they want to buy it in an LLC, right? That's a non-qualified mortgage. And the moment you put a mortgage in an LLC, you don't go Fannie Mae and Freddie Mac. So just some examples here of these two parties kind of getting married. These are the 6 basic types of these loans, okay? And I'm gonna actually do this as these two first because they're connected, okay? A bank statement loan is just that. Liv put up a great post yesterday, sold a big old bulk, had to help some buyers on a big old house, literally $1 million mortgage where all we looked at was 12 months of bank statements. There wasn't another piece of document in that file for their income. We take 12 months of bank statements, we look at all the incoming deposits, we look at some of the expenses, and we determine the income strictly from a company's incoming deposits, and we give them that income. The first time like that's really has ever been done on a mass level. The asset-backed loans, right, kind of sounds the same, bank statement loan, asset loan. This is really determining the activity in the bank account to determine income. This is just saying, hey, what's your balance? What's the balance of the asset? Right? Think rich people. I have $5 million in this bank account. I'm not going to use it to buy the house, but hey, I'm going to make the mortgage every month because I have the $5 million and I'm not going to not pay it. So what that does is it takes $5 million and divides it by a certain number. It could be 120. It could be 240. We actually have a crazy investor that does it by 84 months. And if you want a little bit of extra mortgage knowledge, that is a magic number in the mortgage business. Okay. 84 months is 7 years. 7 years is the average time these 30-year loans stay around. If you look at the last 80 years. So that number is specific. That's a reason why that's 7 years, because they say, hey, while you're probably going to be having this loan on average in America, that's the asset per month based on income. This is the easiest type of loan we can do. Give us a bank statement, divide by 84, there's your income, done. Get an appraisal, and you're done. Now, I'm not going to downplay that. So this one has gotten a lot of pub. Okay, DCSR, DSCR, I'll never say it right. Debt service coverage ratio has exploded. Now, this has been on the broker world for a couple of years, and all it means is what it says. If you can prove to me that your debt service is covered by a certain rate, we'll give you the loan. If you can prove through an appraisal that that home's market rent, and that's important, only the appraiser determines that market rent. Right, so when you do these kinds of loans, you're not just meeting the appraiser, maybe helping them out on what the comps are for the value, right? You're also coming with some market rents. Say, hey, it's really important that this market rent number is $1,600 a month. Here's why, and here's some other data on why this thing's worth $325, and here's that data why. So it's really important that you get that subject property rent correct, because that's what we're basing the entire loan on. Now, those will be a little bit different. The most aggressive, which I market, is a 1-to-1, which is crazy, right? $1,000 in rent, you're basically approved for a $1,000 mortgage payment. That's it, based on subject rents. Now that is going to cost you as well. So that's not a great rate. that's not a great loan. You know, that's gonna be 9.5%, 2 points, right? But you can get in there. Yeah.
Question, so what kind of a down payment is required with those?
So it's interesting, anywhere from 15 to 30% down. And I just said this to Max earlier. Yay, 50% down, like that'll get attractive. Same thing. Now you're going from 9.5 to 12%. I'm making up some number, but I'm not that far off. And 12 to 13 to 14%, you can start to play with hard money, which is true private money. So we usually advise people like, hey, look, here's Ian at Hard Money Bankers. I don't know if you guys know who that is down here. He seems to be everywhere, but there's like a guy that he's actually really good at hard money lending and he's got pretty aggressive terms. I'll give our clients him like, hey, talk to him. It'll compete with us over here and let's make sure like this may not be the best loan for you.
What's the vetting process from vetting the rental amount that would be?
You all,
It's just basically.
conversation with you all. Hey, they're asking for the FCR. I can pre-approve them. What do you think? Is this what he's telling me? It's $1,200 a month. Like, are you feel good about that? What is it? It's $1,100. Does that work? And we just try to have an open conversation.
You don't have to get like a signed lease prior to purchase to try and get that lined up or anything like that?
Yeah, when you get the appraisal schedule, you can write the schedule, which will take market rates as well as the appraisal in consideration.
You don't. And
It helps, it definitely.
yeah, and that's exactly where I was gonna go. Like, if you have some of this extra stuff, if you're a repeat investor, you own your current home, these factors all build out on what you get. And I think that's actually a good topic or just a good point in this, right? Is every code custom, right? Like if, okay, it's a 3 unit instead of a 2 unit. Okay, that's a 0.5 point charge. My credit score is 680 and not 700. Okay, it's a 1/4 point charge. And what I mean by that is there's not a no. It's, oh no, we're not gonna do that loan. It's just, we're just gonna charge you more and more and more and more for every risk factor that's on the loan.
Yeah.
And that's what we call portfolio power. Like, it's just the bank or the lender saying, hey, we don't care about all these other qualified mortgage rules. Is the check gonna show up every month? Right? Interest only loans, we know what those are. So technically, if it is an interest only payment, non-qualified loan. So think jumbo loans, think 5-year ARMs, so pretty simple stuff, but that's more of like jumbo non-QM. I wouldn't rather just put that as like a solution-based product. That's just, hey, I have a really sophisticated client. They do interest only loans and that falls in this category. Credit challenge, pretty self-explanatory. You have folks that will not have a credit score overlay. They don't even care about the credit score. As long as you are not tax leaned, you can get pricing and you can do some of that stuff. Same thing, for every 20 points in credit score, you're gonna pay for it. Same kind of pricing here, 8, 9%, I think those kinds of terms. And then the true jumbo non-QM. So you gotta have these, under $850,000-ish loans, and then you have north of $850,000 loans. So that's a really good rundown of the 6, primary types of non-QM homes. So we're gonna go into a little bit more in each program, okay? So now within each program, you have some different types inside these programs. You have a 2-year, 12-month, or 1099, right? You have a couple different ways of getting to that income based on what kind of self-employed client you are. Think back to a second ago. If you prove to me 12 months, you get a little bit of a higher rate. But if you can give me 24 months of bank statements, now you get a better rate because now we see a longer history. So every factor that you can prove as a borrower that I'm safer on a safer risk, it actually drills right down to rate.
Do you see realtors using the loan?
Yes.
I mean, this is the example of yesterday with my closing. It kind of helps when there's multiple types of income involved in the same loan. My example yesterday was borrower 1 was a W-2 employee, worked at an investment firm for years, very easy income. His wife just became an owner of a dental practice, not even 12 months ago. And they could not get the house without both of their incomes. So for my example yesterday, it was a very strong loan because of their credit score, their assets, the business assets on top of his income. But it was the only way that they could get the house. And because of that, it was kind of a perfect storm because the listing agent knew the buyer's agent, and then we had our pre-commitment that I talked about a couple weeks ago. So that was the reason that the house got the offer got accepted. And then, Jason kind of talked about how these programs typically come with a higher interest rate. These people closed yesterday, the loan amount was over $1 million, they put 20% down and they had a 6.875. So sometimes if you are super risky and you have like nothing to give us, that's where you're gonna be in the 12s. It's also another option for people that may not be able to do the normal way, but we were able to count, her 11 months self-employment history to get her this house.
It's a good point about, fitting those really unique situations into a pretty simple process. For example, a year ago, that buyer never gets that house. Program doesn't exist. They don't buy a $1.3 million house. And by the way, that's a 20% down buyer. That's a traditional jumbo buyer whose jumbo rate at that time was probably only lower, right? So probably 6.75 and they did 6.875. So it really is solutions based.
Yeah, and they got told no by 2 other lenders because of it. So that they kind of came back to us, they were repeat clients, they went out to shop to see if they could find a better interest rate and they got told no by 2 other big national lenders because they don't have the program. So then they came back, we kind of realized that we have to wait a certain amount of time to get close to that 12-month period. But they did, they found the house, we worked out the timing, like literally exactly 12 months of the day, and they were able to get the house.
They're closing. Well, we closed
Our situation,
that 12 months ago.
we had to get an exception because of it was days,
Yeah.
but it was like.
So it's not, so listen, and this is important too, like 9 days we're off on a really strong loan. Perfect credit, 20% down, one guy's W2. And we had to get an exception, all the way up to some executive at Goldman Sachs, right, one of the premier financiers in the world. And they're like, hey, I don't know, and what they write, we'll charge you quarter. So they didn't give it to us for free. They still charged it for us, but we did it. And Liv looks like was a hero to those buyers and facilitated a transaction. So now within the asset depletion, right, what will we use? This might seem like pretty obvious. That's really bold, using checking and savings accounts. Why? Why do you think? Why do you think that's a bold move to allow a checking or savings account to be part of an eligible asset income calculation? Anybody have an idea?
I mean, you could put it in a day.
That's right. That's right. The next day, it's gone. At least with an IRA, a 401k, you got some steps, you gotta make a phone call, right? But this is wild, that we'll give you 100% of the liquid asset. The theory on that is you're probably using it for the house. And it's probably literally the equity that's going in. That's why we give it, that's the logic, but just the different assets, you see stocks, bonds, and then look, this is what, I love mortgage banking, right? It's just really smart. The riskier the asset, the longer term the asset, the less we're gonna give you credit for. So a little bit of backward logic there, that the more safer, sounder asset over a long period of time is actually what we'll give you less of. But same kind of theory as this, right? What shouldn't you be paying your mortgage with? Right? Probably don't want you paying your mortgage with your 401k. Talked about the SCR, I could talk about this all day, but I will just touch. That's really aggressive, right? I said that 1-to-1, it always turns heads. That's what we market that one, is it turns heads, like, oh, wow. You want 1.25, 1.5, right? So $1,000 rent, $1,500 rent, $1,000 mortgage, it gets you 2 to 3 points in interest rate. Put that in context, right? So the DSCR, if you can get yourself more than the 1-to-1, 1.25 to 1, 1.5 to 1, you get much better terms.
And this is a really good tool with investors to talk to them about instant cash flow. If you have a property that you've been sitting on, that you've done the math and you find out that, it's gonna be pretty liquid, pretty quick, this might be a good program for people that might not have the assets or the income to do it like a traditional investment property.
Let's say it's a duplex for this DSCR loan and one unit might not be rent ready. How does that affect the financing?
It depends on what's not ready, right? If it's habitable and they can develop a market rent, we can use it. If it's subflooring, no heat, that's gonna be a problem.
Okay.
But if you're just subject to a thing or two, it depends on what that thing or two is, and we would look at it. Yeah, and that's probably similar to like send it up the chain, hey, here's why. And what else I love about this side of the business is all narrative. Like for that exception that we got on that new one, it's a narrative. The underwriter writes a paragraph, this is why you should do this. And that's what we would do, where that would go to our collateral department. And an actual licensed appraiser that works for us would do a narrative, hey, Goldman, this is why you should take this deal. We know that there's a hole in this and there's a plumbing thing, but hey, it's all being rectified, you know. And actually what I would point back to is like the CO.
Mhm.
So if that locality requires a CO, they can get a CO or attempt CO. Usually these private lenders will play ball, but it's definitely case by case.
So you're still looking at similar down payments, like 15%, 20%, 25, 30?
You really want, again, yes, you can do 15. I don't know if you should, right?
Right.
20 to 30 stuff is really, so I would actually tell you 20 to 30% down payment is actually really attractive.
And then you're using this because maybe,
25 to 30, 20.
so you're really using this when your income might not be enough to buy the property outright, using more of the conventional finance.
Yeah.
Or
Okay, so you really you're looking for that income deferment in order to kind of artificially prop up your purchasing power, because you know that so much, your debt to income ratio gets me to here, but that since that has a 1-to-1 or 1.5 to 1 ratio, that's getting me that last little bit of the way there.
I also would say, I think it's just correlated, and this is just me, it's just correlated that a lot of entrepreneurs and self-employed folks are investing in real estate.
Yeah.
So I think it's just correlated where that self-employed person, we get the tax return and there's all kinds of write-offs. They have 14 times.
Right.
And I hope everyone is leveraging the hell out of owning real estate and using it as a tax
Yeah.
advantage, right? It's for those kinds of clientele where we can say, hey, we'll go through 2 years of tax return and do all this stuff. Maybe it works. A lot of these investors are like, oh, no, I don't want to, I'm good. I'll pay the higher point rate. I'm not going to do any of that
Yeah.
because it's speed. They want to either get in and get out, or they just know that the cash flow is there and they don't care. They're going to pay it. And then they're like professional investors. And a lot of them are real self-employed realtors.
Plus, we've seen too throughout COVID that a lot of people switched their income to being self-employed. So if coming out of COVID, if you were only self-employed for 6 to 8 months, sorry, you can't buy a house with income.
Well, I'm switching all my income tips only now.
Yeah.
Oh,
Yeah.
But that is where,
could you also bump that? And this is the one I'm like most interested in. I
Yeah.
apologize for derating.
it's right here.
Yeah.
Yeah.
So let's say we have a client that's shopping at 300,000 and under for investment properties, and everything they're looking at is just not quite to the condition of what they want. If I can say, hey, I might actually be able to increase your purchasing power up to 350, but we may have to flip to a DSCR loan. Is that like, because I'm thinking about this from the realtor to the client perspective, when I'm teeing this
I
up,
know, it's smart.
hey, they're getting frustrated because they on their own income, they can only get to 300,000.
Yeah.
But if we went DSCR and I can have your 1,500 versus 1,200,
Yeah.
you know, what it would look like, we can maybe stretch this.
Yeah, that's
limit.
smart.
With that, is that how that lever gets pulled?
I haven't heard much of that, and that's pretty clever. Yeah, I mean, as a financial strategy to maybe get up into that next tier of.
Because that's what happened to us right now, right? Is so many of our buyers got outpriced out of the area. Like 3 years ago, I was looking, I was all ready, but now all of a sudden, all that inventory shifted up. So that's where
theory,
right now I use this.
Yeah, totally. I
Yeah. I mean,
the
the only
experience
thing
and
that-
speed, but that's a.
Yeah, the only thing that comes to my mind for that specific is there, can they, with the higher interest rate, can they hold that 350?
Yeah, I see.
Because you're gonna have to do that down payment with that purchase price, so if you bump up, do they have the money, do they have the space income wise, plus, you know, DTI to kind of carry them. So, we have a loan officer in Philly that this is her entire, this is it, her pipeline is all DSCR, and she's killing it. She works for our investors, she doesn't do anything by the book in terms of like Fannie Mae, Freddie Mac. So we have a ton of people that are doing this as all in business.
You've heard me be very confident and outspoken about my team and how proud I am about my past and the business that we do. We're behind on this. Just straight out. Like if you weren't a mortgage broker, you weren't savvy enough to be pushing this stuff for the last 2 or 3 years. So I have no problem admitting that. We are the best in town. In the last year, we've really figured this out. But yeah, man, we're like 2 years behind. This stuff's been out there and been getting deals done for a while. But the problem is, well, not the problem, what I hope we can dispel some of it is that has already started a little bit of a reputation. We like to think we're better than the brokers are pretty good, but they don't have control, right? They really are a pass through where deals get delayed, deals get blown up. And a lot of it is like, oh, DSCR, Banksman, DSCR, Banksman. So you all are kind of hearing this sometimes in a negative, like, oh, I had this horrible deal, there's this thing over here. Well, we also think in the last year or two, we've really cleaned it up and we have something called delegated underwriting, which means that Goldman Sachs, that Deep Haven is another private investor, the Onslow Bay. So these like billion-dollar private investors that you all never heard of, probably outside of Goldman Sachs. You know, these guys have given us the authority to approve and close these ourselves. So think like a year ago, kind of a testing run of like, hey, are we okay with this? And after a year they had. So, you know, we are kind of some perfect timing, some serendipitous timing and how we do these loans now. But I'd like to tell you that we're executing them on a little bit better.
How soon can you close on one of those? You just probably mentioned
So
it.
you get the appraisal,
Okay,
fast and you get the appraisal,
so like
2 weeks.
2 weeks, okay.
If you rush an appraisal and get it back in 20, this is where Liv gets very upset at me, in 2 days. You know, in 2 days, Caroline. If you rush it, we can usually get a report back very consistent in 72 hours. That would be my answer.
And why is that? Why are you increasing the time?
Win the bid. Investors are hot,
Years.
yes.
There's no dogs, there's no,
So you're presenting a commitment on day one and you're saying you can close in 10 days.
because basically the whole deal is we need to know.
And something we haven't talked about that's probably very important to mention to a room, with realtors, it competes with cash. This is what I just said, 10 days.
Yeah.
Right? You can compete, investors can compete with cash investors. And especially if we know the other side and you guys are so sick and tired about Philly, but we'll start to know these other realtors down here. And maybe we get a bunch of them in the office, right, where then we can start to explain to the other side, they start to know us a little bit. We do some deals where we close them on time, and it's kind of like what we need to do. And then it'll be, oh, I know, it's GR, oh, it's Rate doing one of those, like, oh, okay, that'll be a little bit better.
Yeah,
Or, you know, Rate Kings LLC doing DSCR, that's actually the name of Rate Kings LLC, yeah, you're gonna get 3 delays of that settlement, it's gonna be really exciting, and you're gonna hate.
This is kind of like the new conversation that you have to have with your owners about like FHA. All listing agents like hate to go FHA because they think it's riskier. FHA has kind of relaxed a little bit with their, you know, riskiness. And then now this is something that you're gonna have, you know, a talk with the listing agent because they're gonna see that on the offer.
So at some point. Yeah, I mean, look, you're not wrong, Connor. I mean, this is the most conversation we get around. This is the most conversation. How's it work? What to do? Frankly, how can I leverage it? Like, I'd like to buy an investment property too. How can I leverage it?
How does the interest rates compare? I know it depends on the down.
Great
payment
question.
and
Yeah,
the deal.
I mean, so you're talking 30-year fixed rate right now with 0 points. Let's just be aggressive and say 6.99 on a 30-year fixed. If you were in, let's say a jumbo non-QM, the closest thing to that, let's say that's 7 1/8. DSCR 7 7/8, right? You probably get about a full point hit. Okay. 15% down DSCR, yeah, you probably pop the double digits, right? But it's specifically relative to the risk, and that's what's nice. If you feel like, wow, that's really crazy, they're gonna give that mortgage, the rate's gonna be higher. I'm like, oh, that actually makes sense. I would write that. I joke around the team of like, well, would you give them the mortgage? Would you? Yes or no? I'm like, what would you do if you had to write that check? And it is funny with loan officers, it's one of my favorite things to do. Cause they're all, oh, hell no. I'm like, okay, like, what are we doing?
Like, it depends on situation and like, think about who you're talking to. Investors that probably have a lot of money or, yeah, super savvy, they're probably not gonna pay that 10% interest rate for 3 years. They're probably gonna get it 6 months and then they're gonna pay.
And the
This is
interest rate-
really just to get their house, and then they'll make the payments and then they can do.
And we ask them that, because we want to know, maybe we put them in a 3-year arm, 5-year arm. That if we know that, and beg your folks to be honest with us, I think a lot of people too in today's, well, finance world, but especially digital world, they're almost apprehensive to tell us everything, and I beg people, I'm your filter, like, nah, man, I work for you, like, tell me everything. We're your filter. And then we start to figure it out. So just the more we know, the better we can structure it. So again, some of the basics of like a couple things where, high-end folks love the interest only. Remember, rich people are always taught to have the least debt burden they possibly can, play with other people's money. This is kind of what you're doing here. Foreclosures yesterday. I mean, that's crazy. We foreclose on a house and give another mortgage a day after foreclosure. I don't really want to do those, but we will. Non-QM, this is where I'm old school. Like I have no problem telling you, like, hey man, and I hope to have these conversations. I can do that loan. I don't know if we should. Like you in this with us? Like you want to do it, we'll do it. But like, hey, I don't know. And that's where I think we all have been different for a lot of years, is we'll have those honest conversations. And then this is pretty wild.
Do you see challenges with the investors getting outbid using a DSCR versus a cash? Like a cash?
I would say yes.
I mean,
I would say.
as much
Because
as
we
we
have
say they're,
appraisal.
yeah,
You're
as
still-
much as we say they're coming up with popularity, I mean, not as.
No, we've had some lose. And that's kind of why I said, like, if I see the other side and I know them, I'll sell it really hard. I'll call the other side, hey, listing agent, hey, oh, hey, they know me, hey, listen, I'm not messing with you. Like, this will be really clean and we're not gonna postpone that 10-day, close. And we'll beg, and it works sometimes. Because we can get the buyer, if I get that, and this is where I promise I don't interject in real estate negotiations, but I'll at least go back if I have a good conversation with that listing agent and go back like, hey, man, I think you're really close. Can you go 5 more? And it's worked. And they go 5, boom, hey, we got it. So it takes more effort. It just takes a lot more effort and a lot more touch and.
Does the DSCR, competitive offer, you'll throw in that the buyer will cover appraisal gap coverage if that applicable? Can I use that same?
You could, sure.
So you're kind of
100%.
guaranteeing.
We actually had,
The other cash offer.
we had one a little while ago that he wrote a 20, a kind of traditional, I'll go up to a $25,000 gap. Won the bid. So we have no problem with that.
So if they're putting 20 to 30% down, there's no appraisal waiver?
We've had more people with the 30%, 25 and 30% down. I beg people to waive the contingency because I show them like, look, how confident are you in this value? You have a 5% window. And so usually I will get the buyer like, you know what, okay, I'm good. But yeah, we do try to point that out. Hey, ask your realtor if this would help you. This might make sense.
Yeah.
So we'll kind of kick them back to you like, hey, you're allowed to waive these things if you feel comfortable with it.
To waive the finance.
All the time, every day. Every day. Yeah, we close 5 a month. So I mean, one of our guys, Mike, we do it a lot. Puts the pressure on us. This is where she'll throw the computer at. We're happy to do it. We'll do it every day. I'm just joking, like it makes us nervous. Doesn't make me nervous, it makes the team nervous.
Yeah. Like, if you want to read it, I already kind of gave you my word that they're good, but on top of that, we'll make sure it's crystal clear what we need.
Yeah, and more so on the other side of that, don't you dare waive that. It's more of that than it is waive it. Like the waive it is more because we are going to do a lot of the upfront work. And we'll have a good feel for that pretty early on and say like, hey, 80% of the time you probably are like, hey, we're good, waive it.
Yeah.
And actually I would, have that mindset in your conversations early with buyers too. The process has kind of gotten backwards, like I did pre-approvals for 10 years without a document. Like I just the credit report, hey, it looks good, okay, and we close all those loans. You're just not allowed to do that anymore with the competitiveness of today's market. So like, tell the buyers, be thrilled to give us a pay stub and bank statement. In 4 hours, you get a loan commitment. They used to be 4 weeks. That's when I'm old, 10 years ago. It used to take you a month to get a loan commitment. We'll give it to you in 3 hours now. Legit, like a legal teeth to it. You can sue us if we don't get you the loan, like it's real. So some stuff here. We go out, like, are you all, and totally dumb question, but I'll ask it because I'm good at dumb questions. Do you all see sure action Or is the sure action the sure action? Like,
It's a VIP community.
Is that right?
Yeah, it is. Like, there's a lockbox.
the island block you out?
Yeah.
Interesting. So that's the same in
Sussex
Jersey.
County definitely operates for Sussex County.
Are they still doing go pick up keys like Jersey too?
Some of them,
Holy shit.
Just,
That's crazy.
it's ridiculous. They're trying
Well-
to make it better, but
Well, if you ever kick down that door, that we are seeing a lot of this in the Jersey Shore.
Okay.
50 DTI on jumbo, that might sound foreign to you, but every jumbo investor in the world pretty much will stop at a 40 to 43 debt ratio. Okay, and that just means their total debt versus their monthly income. So to go up on 50 on a really risky second home, it's pretty impressive. And this is it. I don't know if anybody can even read that, but you'll give a summary. We can even email this out to folks, but I just put that together with my help of AI. Like, that's it. That is it in a nutshell. That is non-QM. That is really what it is. It is private money looking for a better return and figuring out that the residential mortgage business is a perfect place for it and had a whole lot of demand for some creative lending. That's it. They get to make more money. We get to put more buyers in houses. This is good. I hope everybody learned a little something. And any questions? I feel like we kind of hit it as we went. Any other questions?
yeah. So I think like Delaware's actually pretty good about the rent prices are pretty good comparatively still to some of the purchase prices. Whereas like in Jersey's got hit a little hard because the home prices have gone up pretty considerably, but rent prices haven't gone up quite as fast. So a little bit of an inverse correlation there. Would you say that one of these programs is better suited for the Jersey market? And one of these would be better suited for the Delaware market in that regard?
That's a good question.
that is really.
Really good question.
Hmm.
I can ask them once too, but like I'm trying.
No.
What does that?
And I'm trying to think, I mean, I think that bank statement asset programs everywhere. DSCR more so here than there. Well, actually, no, I want to be careful because you
want that?
you specifically said, right, that rents have been depressed in South.
I would say that the rental prices in South Jersey aren't great compared to how much homes have
Got it.
increased in value.
Just
Like
like a
even
great
if like I
plan.
had to put 40% down to cash flow $200 on the purchase.
So theoretically, that should have you having a higher success rate. Here. Because there probably is some big pressure on that appraisal. You'd be like, "Man,
Yeah, you may not even get to a 1-to-1. Like it might be 0.8, 0.7.
Yeah.
Some.
And that's why we want to have these conversations, because like I just burnt somebody $600.
Yeah.
Like somebody just spent $600 on appraisal and they're not even done their home inspection and I just beat them up. You know, so that's why we try to have these real conversations like, hey, we're good. Does this work? And we set you up, like we tell them like, look, the realtors have the same data the appraiser has, but it is the appraiser's opinion. So you can't, no matter what the realtor, which just advice. So we try to soften them up a little bit because we've had that, like, you said, it's like, oh, hold on. So you have to go kind of out of your way to be like, I'm not the appraiser, but we can do something.
Yeah, these programs are kind of like a blessing and a curse. The guidelines are a little bit more relaxed to allow people to come into the program. But if the program doesn't work, we can't really do that anywhere else. For a Fannie Mae Freddie Mac, it's the opposite. Anyone can do it based on regular income, and if it doesn't work one place, we can put them somewhere else. So it's very much so eggs in one basket, but as long as you kind of have your client ready for it, it's gonna work.
That's a smart way to put it. To give some context to that, Guaranteed Rate has probably over 80 primary investors for qualified mortgages, right? QM, qualified mortgages, 80. 8 will do these, right? So 1/10 the amount of outlets.
But there are different programs. So if you're doing a jumbo non-QM, there might be like 6 different types. That one may be a little bit different. Yeah. That happened actually yesterday. I had them in one program and then one thing the investor would not sign off on, so we flipped it to another one. With
And in that instance, right,
yeah,
right, so they said, hey, not yes, no, just 25 basis point, right, 0.25% of the loan amount in charge. So now in that case, we just ate it. We're not even gonna go back to the consumer with that.
Yeah.
Just boom's done. I mean, it ends up being $2,000, but we don't care. And this is where like, we're here for this. We're not here to go like count money. Now we tell the buyer, hey, this thing happened, we got you. You know, and you can kind of show them where you're transparent, because you can see the charge, so I can show them like, I'm not bullshitting you, I'm not just making you feel good. Like, we ate this quarter for you and we're happy to do that. And that's what I was doing a poor job with Frank in the meeting of trying to spit out, like, we're always gonna make you all look good. If you get us a second option or just something to look at, we're gonna punt it back to you and just, you save the money, whether we do the loan or not. So I didn't do that well this morning, but I wanted to just get that out, like, it's about making you all look good and getting that buyer like, wow. That realtor helped me. And I don't even necessarily, if like they, and this has been my theme for 20 years, if they remember you, I don't need them to remember me. Because you're just gonna drive them back anyway. So it's like, I want to remember you, and then I don't care, you'll get me back anyway.
These good for single family and multifamily? The four
You
units?
can do it single fam.
Can you do it for 5 unit or more?
5 is a totally different animal, you don't even need this for 5.
Right, you get into that whole.
You would get into it, I would tell you like I would change the dynamic of that
Yeah.
totally, I'd give you the.
But you
first
can
option.
use them for duplexes,
Yeah.
duplexes, quadplexes.
It kind of helps your favor, because if you have 3 units, it's 3 different rents that you.
Right, absolutely.
Yeah.
And then you're doing it based on the gross rent of all the units.
We see a really high success rate in multi.
Got it.
That's kind of theory for this, is that you, it's not as risky as a 1-to-1, because you technically already start out 3-to-1.
Or, and I'll ask you all, and I think you just gave me a little bit of an answer, Max, like, are they unicorns here too? Like, yeah, like it's always the goal.
Yeah.
I've tried for 20 years to buy a multi-unit property, I do not even one. I can like, there are like these wonderful ideas and you could make so much money. And I see investors that, oh, no, I'm very jealous, but they are hard to get. They should, yeah, they should. I mean, that's really it, unless, some other questions and different stuff, and I could talk about this all day.
So we've talked a lot about rental properties. Does DSCR translate to flips, and what does that look?
They
Sorry,
can
that's a dumb
absolutely,
question.
they can absolutely be used for flips.
Yeah.
What I would tell you with is we're gonna beg them to give us 180 days. That, will you hold it? And that's usually, I think, it used to be, I'll say that very carefully, that used to be kind of a reno time, right? Like 180 days to get in and out for a good
Yeah.
reno crew, I think is reasonable. But it's a, what's called an EPO. So what'll happen is you pay off a loan within 6 months, they'll come back and it's not great for us. Back for a term.
Okay.
So we'll just ask you like, hey, can you hold it for 181 days? And it's really technical mortgage stuff. When that starts to pay off fast, the investor makes no money and they'll come back and they'll start worsening our rates.
They do, is that when you get that casting?
Recasting is more of changing the term of the loan without refinancing.
Right. That's.
So you could do that too. If you had a lump sum, you could recast the loan and keep it there. Paying the loan off entirely, we just beg them for 6 months. And we greenlit without 6 months. They're like, oh no, it's my grandmom's inheritance, it's 3 months from now, I know I'm gonna get it, I don't wanna wait one day after that. It's like, ah, okay, okay. But we have that open conversation, can you give us 6 months? Yeah. And it goes back to the same, like, tell us, please tell us, like, don't hide from it, like, just let us know, and we'll figure, like, we'll work within figuring it out.
Okay.
It's a really bad surprise. They just pay us.
You're not getting any interest.
That's right. That's
You're
all
not
it is.
working in-
I'll take it back.
Yeah, I've heard that.
Yeah.
So it takes.
Hmm?
Yeah. Yeah, if it doesn't go to the 6. A lot of times it. So
Right,
take it back.
well,
But each investor's different.
Yeah, very well. I'll grab the violin, like this happened, it's funny. You may have heard me on the phone 2 hours ago fighting for one of our guys. They took $5,600. It closed like, this one was over a year, so it was 8 months ago. And so that guy gets a commission, right, negative $5,600. So we got it back, it was actually. We usually do, but it's real, it's real money, you know, and that's why I think I would also tell you, like, these are financial instruments, like, these are people on Wall Street figuring this out. This is not the commodity Fannie Freddie, and that's kind of what I'm saying, like, every little thing has a charge, every little thing has a factor, where almost never, no, we won't do that loan, it's do it, how much do you want it?
Yeah.
Right,
And that's a conversation that we'll have up front too, if they have a lump sum or if they are, you know, rich and famous and they want to pay it off. Like, instead of going this place, we might take you this place. both in our favor and in your favor, because it'll be a better loan for you with.
Yep, yep, and I mean, in all honesty, to be crystal clear, you have to be really careful with those conversations. It is illegal. Tell someone you can't pay off that. So it's like, hey, no problem. Do me a favor. It's literally, that's what I said. Hey, can you do me a favor? You know how hard we worked on this thing? You see how much goes into this? Are you really gonna be out of it in 6 months? I don't know, my head, you're close. Can you call me? And that's it. I just leave it kind of like, I don't go into the whole, that's nobody's business.
Yeah.
But I'll just keep it high level, like, hey, can you let me know? Because then if I know it's happening, I can actually do some things I would have done before where I can proactively handle with management. I'm bored of mortgage stuff, but I can say like, hey, this is gonna happen in April. And then we can actually do some things internally. So it's always the truth shall set you free. The second you know something, let us know. And we're always happy to work with even the ugliest of truths. Paying off mortgages are not ugly. Those kind of technical things we want to know. We beg to know.
What are the biggest financial issues that you see buyers coming to you that they have as to why they're gonna start using a loan like this? Like, what are the bigger
question.
issues that a buyer would have? Like, they didn't do tax returns, or they
Yeah.
have a low credit.
That's the
or
number one thing in my mind.
they just don't have, like a current, they wanna invest right now, they just don't have a current tax return or something.
Yep.
And so you can get around that by using these.
As long as you don't have a tax lien.
Right,
Yeah,
it's not,
we're good.
it's not
Yeah.
a people lien or
Yeah.
anything, it's just.
You just. That could be something. If, you are foreign and you come to the US and you technically don't have a credit score, that's one. But I would say the most common one we see is, I just didn't want to file my taxes, so I don't have taxes.
Yeah.
And it's like, oh, why? And then you kind of get into it.
And then we have to like hold our breath that they don't go into our fancy systems and upload a tax return. Then we have to deny them.
Yeah.
The only way you can get that, so actually that's a good thing. We need to get that in the slide. The most important loan, the most important deal with these loans is don't give us anything we don't ask for.
Yeah.
Like a famous mistake in this, and I unwind it almost weekly for the crew. All of GR, what is GR Billy? They just think like, hey, you didn't ask that W-2, and you've had 3 conversations that were like not using any traditional income, I don't need it, and they'll upload it. Well, I thought you needed it. And the horrible rule of mortgage that I will tell all of you is once we see it, we cannot unsee it, no matter what. It's federal law, we lose licenses, all kinds of crazy, crazy stuff.
And I'm sure you guys have noticed it, like the doctors and lawyers that make $1 million a year, like the worst credit, they save the worst, their assets are horrible. So it's like, that's another example when they're making hand over fist money, but they have like $2,000 in their bank account. So it's like, guys, like, what are you doing?
The doc, you don't wanna get me with theories of doctors. We do a lot of that in Philly because of the meds and ed. We call, all Philly is medical and education. It is funny, the doctors are the worst. Engineers are the best. I love engineering clients. Engineers and accountants just do my job for me. Here's what I want. I saw the 10 years of this. This is what I both done. Can you do that? Yes. Okay, we're done. The doctors are like, whew, good luck getting them on the phone. They already know everything. So you don't have to explain anything to. A lot of fun. Anything else? This is fun.
I
Yeah.
have another question. This isn't really specific for
Okay.
student loans, but are you guys seeing a problem with student loans being
Yes.
default?
Yes, for years.
Percentage, what? Can you give me an estimate? How many are being?
Depends who you
default?
talk to and how much of first time home buyer business they do. We see numerous amount of people have their credit score run at pre-approval and then they get under contract and we hit them with the hard pull. And it's 200 points different because of their student loans.
Yeah.
A lot of a majority of percentage of people that the barrier is cash to close student loans, in my humble opinion. I think those are the 2 biggest prohibitors to getting first time home buyers in the house.
So if they're paying like their minimum, they're fine. It doesn't impact
Yeah.
anything.
Yeah, they're good.
And I would tell you, one of the greatest things, and I shouldn't, you know more about this than me probably right now, so I'll say it very carefully, correct me, but like, get your buyers into IVR. Okay, anybody know what IVR is? Anybody? No? Income, okay. Seriously, all young professionals, call your student loan servicer and get on the phone and say, I want an IVR plan. It's just called income-based repayment, and they have to give it to you.
This is something they're gonna call the student loan.
Yes,
Oh,
yes.
Yeah,
And get on an income-based repayment plan. You can still pay however much you want, and if you want to overpay and pay them off faster, all that is great. But they will ask you for a pay stub and a W-2, and they will significantly drop your student loan payment. And again, just giving you that flexibility to like, they will change the term, okay? It will take you 50 years to pay off that student loan, so it's not great.
and we'll
But
see
it
that
doesn't mean
too.
you can't pay more and still do that. But-
Yeah.
And just again, for context, because I, these numbers out, like $15 a month.
Yeah.
Like, and they'll put that on the credit. report.
See people who did that during COVID. Doing this repayment, and then after COVID, because there is sometimes there's a timeline. Year
Right.
and change it
They
after
have
changing. And then, they'll stop because they hit a certain tax bracket where they can't qualify for that. They can't qualify for this now because instead of their $33 student loan payment 5 years ago, it's now.
I was talking to someone and they have $100,000 in student loan debt from a private company. And they're paying like,
Because you can't really defer.
and they don't even have a degree.
Yeah,
Like,
they should call. I've helped my own brother, I've helped my own brother and sister, yeah, that's pretty crappy, and they should probably call. And if you press hard enough, the private investors are not the public, right, they don't have to do the IVR, like, all
Yeah.
that, but they have them. They don't like to tell you, and they don't like to admit it, but they have the same IVR programs, and tell them. You have to be ugly, you have to say, I can't pay this anymore.
Yeah.
I'm going to stop paying you. Don't miss a payment, don't stop paying, but like, call them 3 times in a row, and like,
Yeah.
either you work with me or I'm defaulting. That'll usually get it kicked up a level at the call center in like a matter of about. Threaten default, like,
Yeah.
I'm going to default.
And anytime you have someone that has student loans, make sure if it's in deferment, you don't have to make any payments, because as quickly as 2 weeks ago, I had a client call me looking to buy a new house. I helped her buy a condo years ago. And she said, oh, I just stopped paying my student loans just because I got like annoyed. She gets the stuff.
people don't understand, and I'm saying that as like a 25 group, so most of my buyers at the time. They're just like, I'm gonna stick my head in the sand.
No, Caroline, it's, I didn't joke, but like my sister, I'm the oldest of 5, my younger sister went to a really great school and she's really smart. And got an email from Joe Biden and just stopped paying her student loan because that email said that they could, it looked really official and all this. And I'm like, holy hell, like, geez. So that's not very fair too. She is an artist, so we give the artist very special dispensation. But it's just crazy that like people really act on that. And I think that's where the government and the news and everybody needs to check themselves. Like, people think that they default that you're telling them the truth. Exactly, it is. So,
And even going off of that. That's what they says. So if they're doing the income base, if it says $15, we hit them for $15. If it says 0 on it, because we have to.
that's a great call.
So if they have over like 5 different student loans, we have to hit each one with a certain percentage to give them like a hypothetical payment of what they would be paying if they were deferred. And that can blow up deals because they think it says 0% on my credit score, so you don't have to pay me for anything. Yeah. So if it says $1 for income base, that's great, we can use $1. If it says 0, we have to hit them for something.
Do you recommend that realtors breach that subject with them, or just hand it over to you guys to handle?
Always different answer. My old school answer would be kick all financing questions. Us,
Yeah.
you're just taking yourself a risk by answering those questions.
Yeah.
You're licensed to sell real estate. I'm licensed to advise on debt.
Okay.
You know,
Yeah, I
You
prefer,
also might not get a full answer.
yeah,
They might not trust you, but they might be.
I think
general, go
I
ahead.
think context is just, it's like what Frank was talking about, you're just trying to show them more options for them, right? You have an hot buyer that says, well, I got really high student loans to that, I can't buy a loan, it's like, well, no, not necessarily, go talk to Jason and Lou. I do think that there are options around
Yeah.
it. And just real quick on that, so if I'm at like a 57% DTI and I need to get down to 50, and I got $600 in student loan debt, I'm not making a ton of money,
Yep.
so that's what I would use that IBR. It would hopefully reduce me from 600 down to 100, and now I'm able to drop that debt to income, and now I qualify.
You just explained 1 out of every 10 VA loans that we do.
Yeah.
The VA loan will take up to a 55. We do, I mean, this is like you just described, a real thing we deal with every week. Hey, we need you, you're approved, but you gotta go beat up the student loan company.
Can you guys estimate what that IBR would be?
We do, we have
Yeah,
calculators.
we can.
So does the web, so do the student loan companies. And that's what else I love when they hang up, it's, oh, they don't do it. I'm like, oh, here, go to this link. Isn't that your student loan company?
Yeah.
They have a
Literally a
calculator.
tab.
But even with people who are saying, you probably have this conversation with buyers all the time. You say, hey, are you getting, before you give an idea of what your credit was? And they say, yes, I checked my credit card app and it says my FICO is 800 plus. Then you bring them to us, we pull it, oh, sorry, it's only 690. Why is it so different? That's the biggest thing with clients is they think that their credit score is so much better than it is because those credit card apps are consumer facing. So they show a different calculation with the FICO score, they only show 1 out of 3 bureaus. So that's another conversation that I have to kind of send, I literally send them the credit report that I pull. When I say, you know, this is the 3 scores that are pulling because you consistently for 6 months and like we can give them. But a lot of them think that, you know, they're in a little bit better shape than they are because they just have the right information.
So is there any like public website that you guys would recommend using to get a good estimate of your credit score?
That's one.
Well, I mean, like.
You can't get the ones we get.
I know.
The closest one is probably freecreditreport.com or one of the CERT, Credit Karma, what's the other one, Cabbage, I think offers it.
There's like Nerd Wallet.
Nerd Wallet. So what I would tell you there is all 3 of those I named are using the exact same algorithm.
Yeah.
Like they've published the free algorithm. And what else I would tell you is there's legislation right now and the Mortgage Bankers Association is pushing really hard. We are about to fall into the consumer model. So that's FICO 10. We use like FICO 12. They're literally material algorithms that are different. And Congress looks like they might actually do something good in like align this.
Oh,
Because
so that
exactly what
people
they've said, like it's the
might have
consumer, it's
favorable
just so, they don't know what the hell. So they're like, dude, 1 score in lending, please. So we're pretty close to having that consumer score
close to
but-
it.
within a year or 2, yeah, probably. You're also gonna hear about
Goes down there. So if you have somebody that we pull for pre-approval, the small credit pool and it says 739, but then if you get under contract and we pull it and it jumps up to a 761, you're seeing an improvement in interest rate because the score went up 82.
and we celebrate that. We
Oh,
jump on the
yeah.
desk, we go out, we give them the lender credit, we show them the lender credit. And I'm belaboring that point because no other lender, almost no other lenders do. They eat it, they bank it, they make money off it.
That's what I was
Every
thinking.
time we will give that back to the consumer. We actually have triggers where our software system tells the consumer, so the loan officer can't hide from it. So it's very real, the advocacy for the home buyer is very real, so. This is fun.
Last question for me on credit.
Yeah.
So I find that the credit repair companies that are out there have an incredibly inverse incentive.
They're
to
as
actually-
predatory as any predatory lender.
Yeah, it actually help them out. So what do you guys like to do from that perspective? Like, okay, somebody comes to you, they don't want to go non-QM, they want to stay.
Yeah.
But they're at a 580.
Yeah, we got a guy.
What does the then kick off from you guys when the credit education happens? for that?
We give them, we educate them, and we give them to a guy that we know won't charge him a dime until results happen.
Interesting, okay.
Yeah.
Yeah,
So
so
it's
it's
a guy
like
we-
$100 a month and we'll get your score, but they're just putting holds on consumer
No,
credit, so it artificially
don't.
props it up.
Yeah, more personal news. My same sister's boyfriend of many, many years. They're a little bit of the hippies. They'll never get married. They've been together since high school. She's 30, she's 36. But he just did that. That pre-approval, my brother-in-law pre-approval,
Mhm.
lost 100 points on credit score because he's in one of those controlled, I forget who, the controlled credit card payment programs. I'm like, "Oh, what are you doing? What are you doing?"
Yeah.
He's like, got a really great job. He's a really smart guy. And like, oh,
And like, they don't know.
he's like, "Oh, they told me."
They don't.
We literally can't. He has over $100,000 of equity in a house in Tampa. They need to move up to Michigan. It's no, rent for 6 months.
Yeah, and
My sister, it's like, it's awful.
the guy that he's referring to that we use is, we'll even give him. one month.
Right.
Then, not the full credit report with all the personal info, but like we give them a couple of trade lines. And so we'll say like, hey, what would you do if this was you? And he'd be like, oh, I see a Kohl's card that hasn't been used in 6 months. Like, go to Kohl's and buy something for $100 and then you get to pay it off. And like, that you 18 points. So like, we'll give him information for the clients that need to improve their score, and we'll tell them, if you have 6 months, what would you do if you?
And he kind of knows, and this sounds so silly, but it's like credit reports are $100 these days, some cases $200, $300. We'll give him the credit report, and he knows that. So in another case where it's not a controlled relationship, so to speak, right, we're hitting them with the appraisal, the credit report, then they're gonna go get Charlie credit report over here. So this is, we made it kind of like one-off with him where he knows never to pull that credit report. We give him the trimer, like he knows that our credit report is the best you can get your hand.
Okay.
There's nothing more thorough, there's nothing more complete. So other lenders, and why I say that is other lenders have, it's a common internal policy to not share credit reports.
Yeah.
We do,
What's part of
right? Yeah,
Yeah.
yeah, with written,
Yeah.
written, our permission, because remember, because remember, date of birth and social security numbers are on our credit report.
Yeah.
It's not the start out, whatever. It's also everyone that's running your credit for the last 5 years. So those are some interesting conversations.
You gotta,
So, and that's kind of what, and we'll get you guys out of here. You're gonna start falling asleep. Like, that's why we say, like, tell us, we're gonna know,
Yeah.
we're gonna find out. It's literally our job to find out every possible reason why not to get that loan. So just tell us the
Yeah,
reasons why you guys, the reasons why you don't think, and then we'll figure it out.
stuff is hidden, but not. So you have something that you can see pay stubs, if there's any out. Like, there's little things that like we can check if you're not getting the full story. Give it to.
What does he charge for credit repair?
I think it's based on how many points it has to improve by. If it's within like 50 to 100 points, I think it's 2,500 or something.
Take a month?
I think
Yeah.
so, until it hits that, yeah, but then if you significantly to improve your credit, it is a couple $100.
And then he usually will give an option, depending on the client, you want to keep kind of like almost like an app subscription, right? Like, hey, 150 now, we're good, right? $29.99. He kind of like has these plans. I think it's very economical.
Yeah.
I've known him for a lot of years. And I think he also knows I'm a little crazy, and if he messes around, like, I don't react well.
Yeah.
So we've had a really good run of multiple years, and they do a good job. What I would tell you there of getting your patience. Months and months and months. Like, even with that deal with my own family, it's like 6 months. She's like, no, Mayor, like, you're out. Like, just 6 months and maybe a year. But like, it'll be good. And then I got on a savings plan. Then you just do other things. Like, hey, can you save this much per month? Can you do this? Can you do that? And now we're gonna do other things, not just improve the credits. So there are ways to like make it positive, make it constructive, but we have to know the BS first. But yeah, man,
Super helpful.
Thank you.
good,
Thank you.
good.